Hey guys, Omar Khan here from Theta Trading, and today's topic of discussion is going to be how do we pick stocks? I want you to look for these 5 things, okay? Now, it's not easy to pick stocks because you don't know if you're getting the next Apple or you get the next BlackBerry, right? You don't know. You could be getting the next Kodak, a company that may not be around because you're not looking at things. I want you to look for these 5 things in particular, okay? Now, before we do that, if I could ask you guys a huge favor, we're almost at 1,000 subscribers. I would love for you to hit that like button, subscribe, consider promoting this to friends and family because this is what gave me my economic freedom. I know it can do the same for you. Financial literacy is for everyone. Also, if you want to know more about what we do here at Theta Trading, consider booking a call with us on the link below. We sell puts and generate income simply for agreeing to buy stocks. Look at one of my previous videos on riding naked puts. It is an absolute financial life changer. Okay, so let's get on today's topic of conversation. How do we pick stocks? Look for these 5 things. First one I want you to look for, this is very important, maybe the most important, is the economic moat that the company has around them, which means, is it difficult for other people to enter this business in terms of how much money it will require, how difficult it is? And let me give you a couple examples, okay? Now, if there is a restaurant in your neighborhood, okay, let's say it's a pizza joint. All right, fine. Now, if you want to open another pizza joint, what are the barriers to entry? What is that economic moat that company has? It doesn't have much. They're selling pizza. Yeah, maybe their pizza's a little better than yours. If you have a few bucks and you have enough money to ramp up and a little know-how, you can open up your own pizza store and compete with Pizza Hut or any other big national chain, correct? Now, that shows you that Pizza Hut, for example, wouldn't have a huge moat. Now, they have their brand, of course. They have something called economies of scale. The more you produce of something, the more you buy of something, the cheaper it'll cost. So they'll have a bit of advantage on you. But the other advantages they don't have is they don't have a person who might not care as much as you do as an owner-operator, and they'll have franchise fees. Okay, so that is a moat around a pizza business, not a very strong moat. Now I want you to think of a moat around a business like a Microsoft or an Apple, okay? Now, I'm recording this on an Apple device. What moat does Apple have around their business? Well, their iOS software. That is the biggest moat. There are lots of cell phones in the world. There's all kinds of brands. In fact, BlackBerry still makes cell phones. But people, a lot of people that is, choose Apple. It's because of the operating system, the iOS. Now, to some extent, it is also because of their hardware. People love the phones, but you can get great phones elsewhere. Samsung makes a great phone. Hey, Nokia makes a great phone. But doesn't mean that people want to use them. It is the iOS software which gives it its moat, okay? Now, let's take a look at Microsoft, for example. Now, Microsoft has many, many lines of business. Let's focus on Windows, for example, okay? That's what most people know Microsoft for, Microsoft Office. Is it easy for another company to go in there and make new software and then get market penetration and get people to switch from using Excel and PowerPoint and Word? It's not easy at all. It's very difficult. That's one part of their business. So what you want to look for is an economic moat. How hard is it for other people to compete in the same space? Now, that means if it's hard for them to compete, that means you'll have pricing power. Your margins should be higher. You should be able to sell your products and services for higher because other people simply can't compete with you. Okay? So first things first, guys, look for the economic moat. If you go into a commoditized product, for example, pizza business, sometimes the biggest point becomes price. You do not want to compete on price as a business. You want to compete on value add, not on price. If you compete on price, eventually you'll go out of business, and the thing that's going to suffer most is your margins. So look for businesses that have big economic moats around them, very difficult for others to compete with, and have higher margins. Now, number 2 thing we're going to look for, is the company profitable or are they losing money? So oftentimes when a company starts, they are losing money. Now, where you're going to find this when you're looking a company up is you're going to look at your earnings per share, or also an acronym EPS, okay? Earnings per share. You're going to look at how much this company is actually making or not making, okay? So you can have a great idea, fantastic idea, but if the company hasn't implemented that idea and started making money yet, well, that company may be in trouble if the market starts to pull down or if the economy goes into recession like we have or are in right now, okay? And I'll give you a couple examples of this. Let's say, for example, you have a company and the profitability is not there, okay? And they have a lot of debt. Now, we're going to get to that a little later on. They've got no profitability, they've got debt, but they've got a great idea. They're gaining tons of market share. They're burning through money that they're not making. So they've got a bunch of money on hand, either through a loan or an equity build. So they've got a bunch of money on hand. Now they're burning through this money to grow their business. If the economy happens to go into recession, is that business going to be able to survive? Right? And that's why a lot of businesses go broke during a recession. So in this particular economic phase we're in right now, we have had interest rates go up substantially. So if you have a company with a lot of debt that's not making money, what is happening? Well, now the interest payments on that debt has gone up and they're not making money. The stock market will not like that. We saw that in 2022. Now, if you take a look at companies that do make a lot of money, have strong balance sheets, take a look at an Apple or a Microsoft. Again, these companies have moats around their business. They have tons of capital on their balance sheet, cash on their balance sheet, okay? And they are able to survive these economic storms. And the reason they can do that is because they are profitable. So even if the economy were to pull back, it's not the end of the world for them. They're able to withstand it. Their profit may go down or stagnate, but it doesn't mean the company would go bankrupt. If your company is burning through cash, well, hey, it might go bankrupt. Now, that company with all that potential may have more upside. I'm not saying that, but it comes with risk. So that's not number two thing to look for. Look for profitability of a company. Now, you can look up all these things under investor relations, under any publicly traded company. You go to Microsoft and Apple or Coca-Cola, whatever it may be. Look under investor relations and you'll be able to see all these things. Profitability. You can go to Yahoo Finance and just look up things like earnings per share. Start educating yourself on what to look for. Number three, the number three thing you want to look for is the price of the stock. Now, the actual price of the stock doesn't really matter so much. People are like, oh, well, this stock's trading at 100 and this stock's trading at 50, so the 50 stock must be cheaper. Well, that's not how it works. It is the number of stocks that you have outstanding, which is called your float. So, for example, if I'm company A and I have 100 shares outstanding at $10, well, my company's valued at $1,000. But if I'm company, let's say B, and I have a $50 share price, but I have, let's call it 5,000 shares, well, the company is actually worth $25,000. It's worth a lot more. So it's not the price of the shares you're looking at. What you want to take a look at is something called the PE ratio, the price to earnings ratio. So that is the price of the stock divided by the earnings, and that'll give you a number, okay, an earnings ratio. Now, if your company has no earnings, you will not have a PE ratio, okay? But let's go through a few examples of how this works, okay? So, for example, if you're picking a more mature company, let's say like one that's been around a long time and that's not growing super steadily, they don't tend to have big PE ratios or high PE ratios. Take, for example, a company like a Coca-Cola or a bank stock in Canada. Let's take a look at Royal Bank or TD Bank. So Royal Bank and TD Bank traded a PE ratio of roughly 8, 9, 10 times earnings. So that means for every dollar of earnings, they're valued at 8, 9, or 10 times that amount, okay? Now, if you go to a company like Apple or Microsoft, they're valued at 25 to 30 times. That's their PE ratio. You're thinking, well, why does Apple and Microsoft cost so much more than a bank stock? Well, the reason is because the company is growing at a faster rate. So you are paying more for every dollar they earn because they are growing faster. The banks are not growing as fast. They're more steady Eddie businesses. They pay out a dividend, which is your share of the company's profits, okay? And that gives them low P ratios. Now, if you go to another company, let's say like a Tesla's trading around 50 times earnings. So their PE ratio will be 50. So if you look at Tesla trading at 50 times earnings, and you look at the Royal Bank of Canada trading at 10 times earnings, you're like, wow, Tesla is really overvalued. Or if you compare Tesla to a Ford or a General Motors, which are trading at 8, 9, 10 times earnings, you're going to say the PE ratio on a Ford or General Motors is 8 or 9 or 10. Okay? The PE ratio on Tesla, again, a car company, for some people, is trading around 50. Now, the reason it's trading around 50 is a lot of people, including myself, don't view it as an automotive company. So I cannot assign the same PE ratio that I do on a Ford or a GM to a Tesla. Now, second thing is, because Tesla is growing so fast, you see more of them on the road every day. They're getting into more and more businesses. They're changing the world. That's why the market will give a higher PE ratio to a Tesla, 50. It's going to say, you know what? We're happy to pay 50 times for every dollar that you make. Why? Because we think you're going to make a lot more dollars down the road. Number 4 thing you want to look for is debt. If the company is carrying a lot of debt, now we talked about this a little earlier on. If the company's carrying too much debt, is it going to be able to service that debt? So if inflation or interest rates go up, could it service that debt? If an economic recession happens, can it service that debt? So if you're growing your company and you've got a bunch of money that you're borrowing to grow that company, and for, when the economy is good, you're able to pay that loan off and make profits, great, you're able to make money, and you're able to pay that loan down slowly, you're in a pretty good spot. Now all of a sudden the economy changes. Now interest rates go up substantially, markets come down, your business slows down. Now, are you able to pay that debt? And if you are not able to pay that debt, guess what happens? You go bankrupt. And your share price or stock price could suffer substantially. Now, one of the things you want to take a look here when debt is can the debt be covered in 3 years of cash flow? So you want to look at debt to cash flow. And again, this is available on the investor relations sites, any site you go to when it comes to, like any company that you look at, just look under investor relations and you'll see how much debt they have. Compare the debt to their cash flow. You want to make sure the cash flow can pay the debt off in 3 years. If it's a company that's growing faster and has more debt, you can go 4 or 5 or maybe a little higher. But the point is, you want to make sure they're not overly burdened with debt, okay? And the last thing you want to look for when looking for a stock is not a stock at all. If you don't want to do any of this homework, right, what stock to look for? Look at buying an ETF. And now what we do here at Theta Trading is we sell puts. We get paid a lot of money simply for agreeing to buy stocks, or in this case, I'm saying, look at an ETF. So if you're saying, you know what, I don't want to do all this homework. Okay, great. You can buy ETFs, exchange traded funds, which means, let's say, for example, the S&P 500. That has an ETF called the SPY, SPY. That is all 500 stocks of the S&P 500 all rolled into one. So you don't have to worry about the moat or the debt or any of that other stuff. All you have to worry about is, do I think the markets are going to go up over time? And historically speaking, in the last 50 years, the S&P 500 has gone up 11.25% per year. So now that's not every year. One year it might go up 20, the next year might be flat, the next year up 10, the next year down 5. But the point is, the average has been 11.25. So if you don't want to go over all this process, you don't have to. Stick with the ETFs. Now, what we do here at Theta Trading, like I said, guys, we sell puts, which means we get paid a lot of money simply for agreeing to buy stocks or ETFs that we want to buy, that we would have bought anyways. And we get paid a lot of money for it. If you want to learn more about that, book a call with us. Anyways, guys, I hope you guys learned a lot today. See you soon and take care. Talk soon.